All right, guys, we're back again with another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. Oh man, today we have a great guest, Tom Higgins of Terra Capital. Great to have you on the show. Really appreciate it. Let's start off by giving the audience a little bit of your background. What type of real estate you do, how long you've been in the business, so on and so forth.
Sure. Well, thank you very much for having me on. Excited to be here and excited to add as much value to your audience as I can. I'll try to keep this as short as humanly possible. So I started real estate when I was in college. I went to Columbia University in New York City. I was studying finance. And I had always, from a very young age, wanted to kind of understand what this real estate game was. And my logic at the time, and I think it still holds true today, was to get as close to the asset as you could, as early as you could. So I got my salesperson's license and applied to 10 brokerage firms in New York City and was able to get a job at one and started riding a bike around Harlem, renting apartments. And then at night, I was studying real estate finance outside of school. And I leveraged those two to get an internship for one of the largest developers in New York City, company called Rose Associates. I was able to turn that internship into a full-time job and worked there for many years and was involved with some very interesting adaptive reuse as well as ground up development projects. Then I went and I worked for the Lennar Corporation. Lennar is one of the largest home builders in the United States. I worked for their wholly owned subsidiary, which was a conglomerate of multiple private equity funds that did ground up development in New York, New Jersey, Connecticut, and Pennsylvania. Now, today, I run my own company's operations and value add teams, all told, quickly approaching 2,500 units renovated or developed to date.
Yeah, thanks for giving us a quick background. I was just joking with you before we press record. So you don't have any gray hairs yet? It's a challenge, right? So the multifamily space, and you're primarily in the suburban Pittsburgh area.
So our company is in Pittsburgh, Columbus, and Indianapolis.
Okay.
It's very strong, recession-resistant Midwestern cities.
Okay. And the type of units are they like
all small value add multifamily properties.
Okay.
We like 10 units is our sweet spot. We kind of see the best deals in that range.
Interesting. So why the smaller units? Is it easier from a disposition standpoint that you guys have that business model versus having 100-unit building, 50-unit building? Why is the model smaller units is better?
In my experience, when you're in this space that's too large for a house flipper, but too small for a syndicator or developer, you have access to the highest yields.
Correct.
So it's kind of an underappreciated asset. And our thesis is to buy these predominantly off market and we roll them into large cash flowing portfolios.
Excellent. I love it. Yeah. So a lot of people, when they get into the multifamily space, they look for the big deals. I actually just got the book 10X is better than 2X or something like that. I think I didn't even crack it open yet. I got to read it. I think it's Dan Kennedy or Dan Sullivan, one of those guys. Well, it's basically the same work, so you might as well work on something larger and get the same value versus working on something smaller. But I do like that because we actually have a similar model where we buy there's 40 units is the smallest, between 40 and 100 and 150, not more than 150. We like the smaller units like you because from a disposition standpoint, it's a little bit easier to get rid of. A little bit more challenging when you're trying to sell a 100-unit building. There's a lot that goes into selling something that's worth $10 million or more. So yeah, that model allows you to liquidate the portfolio and get chunks of cash in faster versus trying to sell 100 doors. Why did you guys pick as you say, recession resilient areas? Was it just the amount of off market deals you get in that market? Is it landlord friendly? What is the deal with that market you're in?
Well, you said it well, definitely checks those first two boxes. Also, we like to look at what is the underlying job sectors that drive the city. Are you over-index into technology and therefore, kind of the first to laid off sort of market? Or are you backed by hospitals and big education centers that are the last to laid off during a downturn, if at all? We're looking for those essential workers, the last people to get fired in downturns. We like a very stable playing field because our model, being very heavy value add, allows us to stabilize that really high yields. So what we need is healthy markets where we're not worried about any political headwinds, where there's true natural affordability. The average 22 to 35-year-old only needs to spend 25% of their annual income on rent, leads to kind of a higher quality of life altogether and a happier resident demographic.
Interesting. Speaking of headwinds, not political, just what's happening in the market. How is that affecting your business model? I mean, the cost of capital is what drives the bus. How is that affecting your current model with acquisition and things of that nature?
As I mentioned earlier, so my background's at the institutional scale. So building very large buildings, you're a victim of SOFR. To go ground up today with the cost of capital where it is, majority of deals do not pencil. You cannot stabilize above interest rates. You're not building to a high 7 cap. You're not building an 800 unit deal to a high 7 cap in any tier 1 or tier 2 city, unless you've owned the land for 100 years and contributed to the project for $0. Even then, it's very difficult, right? So you need a strategy that allows you access to high enough yields on cash, like your stabilized yield on cost, right? Unlevered. You need to be able to access deals that are in the 8s, high 8s, to be able to absorb where interest rates are today. When we formed our company and officially kicked off January of 2022, I think the writing was on the wall. And a big part of our thesis was to get into markets that are stable, but also get into assets where you can achieve those high stabilized yields on cost. So for us, we've just been laser focused on making sure that we're buying well, we're renovating well, and we're stabilizing with a large enough spread over where we're getting debt today for debt to still be accretive.
So the current headwinds in the marketplace, because your model, I guess you built out some internal stress test mechanisms to kind of help you have a buffer, a hedge against what's happening in the market by targeting deals that have a higher cap rate at acquisition.
Higher cap rate at stabilization.
Okay.
That's exactly right. So buying a 4 cap in Austin, you have a problem. Buying an 8 cap in a recession-resistant market like Columbus, Ohio, you're probably okay. That's more or less the way we think about it. What I can tell you is that as regional banks stop lending and larger banks stop lending and national banks stop lending, it's hard for anyone in the levered asset industry. Debt funds are being raised right now and debt funds are getting more competitive, but having higher cost of capital makes, I think, for everybody, real estate more difficult. I believe that most people, unless they have very, very, very strong lending partners that they've confirmed are still liquid, should be doing deals that are financing contingent so that they're not putting at risk their deposit. We try to do that on all the deals that we do. You don't always get it, but we do have mechanisms in place where we've already got the commitment for the lender. We verified that we believe that the lender is still has the ability to loan. But it is in the last, I would say, 6 weeks, maybe a little bit longer, I've seen it getting more and more difficult, even in our high yield space. I can't imagine what it's like for people doing deals in the high 5s or low 6s. I can imagine it can get really, really difficult with debt coverage ratios. So
why are you passionate for real estate investing?
I am passionate for real estate investing. It's a good question. And it's not something that I think about often because I'm like so head down, but I've always been fascinated by it since I was very young. I remember I was in a yellow cab with my mom looking at buildings in New York City and being fascinated by how they were built, not from an architectural standpoint, but from like a very big picture standpoint. And that was something that always fascinated me. And I kind of set out the initial part of my career to figure that out. And I did figure that out, and I have built buildings, and I've done that in New York City and New Jersey, et cetera. But it didn't end the story for me. It only kind of made me more excited about the asset class. And as I learn more and more, there's always something new. Every day is a challenge. There's always a new angle. There's always a new way to drive value. I mean, this week alone, I've learned 3 new things that can improve your NOI on properties that I had never even considered before. So I think what drives passion for me is the amount of value a capable or sophisticated or roll up your sleeves type of operator can drive in this business. And I think it provides an opportunity for us to continually get better and better. And you're never going to know it all, or really even get close to that. And that's something that kind of excites me every week to try to improve a little bit more, a little bit more, a little bit more. And I get a lot of value out of that.
Yeah, I actually have a sign on a board in my room that says, "Did I get better today?"
Yeah, exactly.
And I ask myself that question every day. Yeah, it's always fascinating business because you never learn everything in this real estate business. That's what keeps me excited about it also is every day you learn something new, or every day is a challenge. It's not the same old boring, dull thing, right?
100%.
It's real estate. So yeah, let's talk about a little bit more where people can find you. If you want to plug your website, we have all types of people watch this, whether they are investors, neophytes, people who are just getting started. The whole goal is to add value to the investment community as a whole. So I know you have the USA Terra, TERRA.com is the website. You're also on Twitter, at Tom Higgins on Twitter. I haven't really went deep on Twitter. I'm on Instagram and everything else.
Oh, you're gonna love it.
I haven't got the Twitter bug yet.
So I got turned on to this maybe 6 months ago, but there's hashtag RETWIT. And if you follow that hashtag, it is a very, very deep and very impressive real estate community. Lenders, developers, operators, agents. There's a massive national ecosystem on there. And I've met partners on there. I've sourced deals from there. It's a pretty impressive network that I never knew about. And there's, people really promote good, interesting real estate content. And so some really great stuff rises to the top, and I'm on there every day. I think it's a very valuable forum.
Yeah, I have to definitely check that out. Thank you for that. I really appreciate it.
Yeah, of course.
Yeah, man. Thanks for coming on the show. I really appreciate the value you added. And if there's any other way our listeners can contact you, I know we give your website and your Twitter feed.
Yeah, it's perfect. All the links are accessible on our website, and like I mentioned, Twitter is a great place to connect. And I'm always happy to help. You were asking what excites me about real estate earlier. I get a lot of value and energy off of helping people when they're starting out. And it's something that I try to carve out at least an hour or two, sometimes 3 hours a week to do. I had 2 calls earlier today talking to people just starting out, just graduated from college. And I really, really get a lot of value from that. So I'm always eager to help when I can.
Yeah, that's amazing when you find people like that. It's actually it's fulfilling, right? Because secretly we're probably real estate junkies, and
We definitely are. We definitely
we
are.
like to talk real estate all day, every day. So
Yeah.
they're like, I don't want to bother you. Like, no, you just keep
Yeah.
going, keep asking those questions.
Yeah,
I love it.
exactly.
I actually use social media as like a customer service hub. People hit me in the chat, and I'll steer them in the right direction, and it's fulfillment from
For
that.
sure.
Somebody get to that next level. So yeah, thanks a lot for coming on the show. Really appreciate you. It's been a plum pleasing pleasure. It's another great episode of PFREI, a passion for real estate investments. Make sure you guys check us out on social media channels and wherever you find the latest and greatest podcasts.